I think there's some kind of, okay, there we go. I'm really honored today to have Connor Seabrook with us. He is a old friend. We were just talking about how many years we've known each other, going back to the early 90s. And Connor has had a really interesting and diverse career, both as an executive in tech-based startups, one of which I was also involved with, and also as a venture capitalist. He has over 30 years of experience and is currently at the Georgia Research Alliance, where he's the managing director of the GRA Venture Fund. And the GRA Venture Fund is a public-private venture capital fund that invests in promising young companies from Georgia. Before joining GRA, Connor was a partner with the Alliance Technology Ventures, which was a $250 million venture capital firm, and that's how I really got to get to know him. He was also the CFO of Aspen Venture Partners, which was a $150 million venture fund, and he was associated with 3i Ventures, which is a publicly traded equity firm based in London. His business experience includes senior management roles at a number of companies, including the publicly traded Athrogenix, which I was also an employee at and knew him very well then, and at Inhibitex. He also had experience with Goldman Sachs and Company in the U.S. Trust Company of New York. Connor earned an M.B.A. from the Amos Tuck School of Business Administration at Dartmouth, and he holds a B.S. in Environmental Studies and Economics from Trinity College in Connecticut. With that, I'm going to hand it over to Connor.
Well, Cindy, thank you very much for that kind introduction. It makes me realize that it's taken me a long time to accomplish that, so I'm obviously not very efficient with my time. But delighted to be with you here today. I know you're all excited about another Zoom call. As Cindy mentioned, I've been in the venture business for over 33 years. GRA Venture Fund is my fourth venture firm that I've been involved with. And I've also sat on the fundraising side of the table, so I have appreciation for the challenges and how difficult it can be to raise money from various sources. Without further ado, I'll just get started. So this is an overview of what we're going to talk about today. Some of the resources you can obtain to fund your enterprise include grants, debt, safes, equity. I'll go into more detail on each of them. And obviously, you can pursue more than one in parallel. And then at the end, Cindy had asked me to give a little primer on stock options. So we'll do that at the end of the talk. So to start with, one of the first decisions, assuming you've made the decision to start a company, that all the advice you've gotten from friends and your significant other, and whether you're crazy enough to do this, you've decided you want to do it. One of the first decisions you'll have is, how do I structure my company, as a C-Corp or as an LLC? And so it just kind of listed some of the differences here so that you could see them. But, obviously in a C-Corp, you're going to be owning stock as opposed to a limited liability company. You're going to have membership interests. In either case, there can be different classes of stock or membership interests. The management in a C-Corp is going to be done by the directors and officers versus an LLC. The management will be by either all the members or members that are designated by the operating agreement. And for a duration, C-Corp is indefinite. An LLC will dissolve as specified in the operating agreement. So if there's a loss of a member or whatever the criteria are that terminates the LLC, it could even be a date, that's when the LLC would terminate. The one, probably the most important criteria from my perspective is the tax issue. In a C-Corp, there is the potential for double taxation, because if the company is profitable, it'll pay corporate taxes. And then, of course, if it's paying compensation to its owners, they'll be paying personal income tax on that compensation. So there is the potential for double taxation. Typically, a startup isn't profitable right away, so that's less of an issue in the beginning. As opposed to an LLC, that's a pass-through entity, meaning that any losses or profits that are generated by the company will get passed through to the members. So what a lot of entrepreneurs do at the start is to set up as an LLC because they can use those losses on their personal return. But the challenge is that once the company flips around and starts generating profits, if they don't convert to a C Corp, those profits will also show up on their personal return and can generate phantom income, meaning you're reporting that income, but you may or may not actually receive the money. It's being generated by the company, and if it doesn't pay it to you, then you'll still be paying taxes on it. So what a lot of folks do is they'll set up an LLC while they're generating losses and then convert over to a C Corp when they get to the point where they're generating profits. Other people will start at the C Corp right away. Another feature of C Corps is that the vast majority of benefits are available to the owners versus an LLC. They're not. And the losses that are generated by a C Corp early on are not, it's not like they disappear. They are carry forward so that when the company starts generating profits, they can offset some of those profits with losses generated in prior years. So that's just kind of a quick high-level overview. These are basically your two choices, and obviously when you get to the point of setting up, your attorney can help you sort through which one would be better for your particular situation. So why don't we start with grants? So grants are obviously non-dilutive. There's no obligation to repay them. And they can convey credibility because they're typically competitive and peer-reviewed. So, they do add some patina to what you're working on. The I wouldn't say downside, but some of the issues related to grants are that the expenditures may be restricted. In other words, you can't just spend the money on anything. And they may have a long lead time in the application, which, so you're uncertain whether you're going to get approval until you get it. And then even when you get approval, it's not clear when the funds are going to arrive. And if you get the funds, it's not clear whether you're going to be approved for the next phase. So, there's some challenges with grants, but it is a source that we always encourage our startup companies to pursue because it is non-dilutive. So the GRA has a grant program. The funds go to the university to support the development of intellectual property, and that's to adhere to Georgia's gratuity laws, which basically state that state funds cannot be used for the benefit of a private company. So the grant funds go to the university. They can then fund work in your lab, and then when a company is formed, that company can license the intellectual property from the university. We have two grant programs, a phase one, which is up to $50,000, and a phase two, which is up to $100,000, so in total $150,000. And they're typically tranched and milestone based, and the phase two does require matching funds. There's certain limitations for what the funds can be used for when you receive GRA grants. So it cannot be used for salaries, for payment of patents, tuition, capital equipment, and anything specific to the company, such as creating a website. Grants that are available beyond the GRA, you guys are all familiar with. You probably know more about this than I do, but there's the SBIR grants, the STTR grants, and then the America's Seed Fund, which is part of the National Science Foundation grants. And the grant programs for those entities, curiously, are set up similarly to the GRA, meaning that the phase one, it's really about proof of concept, demonstrating feasibility. The phase two grants are really prototype development, scaling up. And then obviously there are no phase three funds available for commercialization. Okay, next comes debt. And at a very high level, there's two types of debt, straight debt and convertible debt. And convertible refers to the fact that the debt would convert into equity. So on straight debt, it's not dilutive, similar to grants in that respect. There is an obligation to repay the principal and interest per the schedule that's agreed to. The type of or the use of the monies is typically unrestricted, and it may or may not include some kind of equity kicker, typically in the form of warrants. And warrants are similar to options that we're going to talk about at the end of the discussion, so I won't go into detail on that right now. The attorney cost for debt is relatively low compared to equity, and there's less risk for the investor since it's senior to equity in the event of default. So straight debt can come in a variety of ways. It can be secured by assets of the company. It can be secured by a personal guarantee, meaning if the company can't pay it off, you're on the hook for it, or whoever guarantees it is on the hook for it. It can be senior to other debt. It can be unsecured, and it could be junior to someone else's senior debt. The GRA does have a phase 3 loan program where it will lend up to $250,000 to companies. Again, it's typically tranched and based on accomplishment of milestones. In our case, it's 5% simple interest, no payments for the first year. The interest does accrue, and then interest only for years 2 through 5 and a balloon payment at the end of the 5th year. Our notes are typically senior unsecured. There's no personal guarantees. And it does come with a 15% warrant coverage. So that refers to the fact that it's the dollar value is 15% of the amount of the loan. It's not 15% of the company that you're giving, 15% of the value of the loan. So for example, if it's a $100,000 loan, it would be $15,000 worth of equity. If it's $250,000, it'd be $37,500. And that's usually a pretty insignificant amount of equity if the company is worth several $1 million. So then you have convertible debt. And this is typically used when it's difficult to come to agreement on the valuation of the company, or some funding is needed quickly. It is dilutive when it converts to equity. Interest typically accrues and is converted also. And again, similar to notes, what you can spend the money on is unrestricted. Most notes will include a discount and or a valuation cap. So I want to pause here and talk about this for a second. So discounts generally are 15 to 20% in the market. And the valuation cap is something that would be negotiated between you and the note holder. But just as an example, if you had a $1 million loan and a $10 million valuation at the next equity raise, if there was a 20% discount on the note, then your note holders would be converting the note and interest into equity at the equivalent of an $8 million valuation, not 10. It would be they would get the 20% discount. If there was a cap, say, of $7.5 million, then they would be converting at 7.5. They get the lesser of the discount or the valuation cap if they're both in play. So just as an example, if you know a $1 million loan converting a 10 million valuation normally be $1 per share price, or $10 per share price. If with the 20% discount, they would be buying shares at $8 rather than the 10. And if it was the 7.5 cap that was in play, then they'd be buying shares at $7.50. So hopefully that's clear. Notes may also include a change of control multiple. So this covers a situation where the company doesn't raise an equity round, they get acquired, and therefore the note never has a chance to buy equity and share in the upside. And so it may have a multiple of, say, 2 to 3x. So in my example, if there was a $1 million loan and you sold the company for 10 million instead of raising money at 10 million, then the loan would get, if it was 2x multiple, then you'd pay 2 million back on the loan. The attorney costs are obviously a little bit higher because the convertible debt's a little bit more complicated, has these features that have to be sorted out. So it's a little bit higher than straight debt. Safes. These are very popular. They're popularized on the West Coast. Y Combinator, I think back in 2013. They're very simple security, so therefore legal fees are very low. And in essence, it enables an investor to buy shares in a future round. The safe will likely include a discount or a valuation cap that would work exactly as I explained for a convertible note. It is a little bit riskier for the investors in the sense that repayment is not required. There's typically no maturity date, so it could just sit out there perpetuity. And there's limited case law if it goes to court. So I can tell you that we've considered investing in safes at the GRA Venture Fund, but on advice of our attorneys, that's not something we will currently invest in. But a lot of people will, and you can get it. There's lots for the company. All right, so now we get to equity. So this is dilutive. Investors are buying a percentage of your company. So must agree on the terms related to that, and they're summarized in a term sheet. One big decision is whether you're selling preferred versus common stock, and in general, there's two types of categories that you need to consider. One is what I refer to as the economic implications that really dictates, in the event of an exit, it dictates the waterfall of how the money would flow to the investors. The other, which I think is equally important, is the command and control provisions. And we'll talk about that more shortly. Attorney costs are going to be higher for an equity financing, and it's the highest risk for the investor since obviously it's junior to debt, junior to convertible debt, junior to liabilities, but it's also the potential for the highest reward because they're obtaining a share of the company. So if the company does well, they will do well. So let's talk about the economic considerations. Most people talk in terms of a pre and a post money valuation. So the pre-money is the value of the company prior to the investment coming into it. Post-money, not surprisingly, is the value after the money. So if you had a 10 million valuation and you raised, say, $5 million, the pre would be 10, the post would be 5. The preferred typically has rights and may have a waterfall that is senior to the common at payout. So this sort of gets into the economics that I was talking about. Preferred also typically has a dividend that may accrue and would get paid in the future. And it could have a liquidation preference, meaning it would get a return of the initial investment plus any accrued and unpaid dividends. There's also participating and non-participating preferred stock. Participating represents a double dip. So as an example, let's say you raised $3 million and sold 25% of your company, and your company then gets sold at $15 million. Your investor, if it was participating, would get their $3 million back plus 25% of the remaining $12 million, the 15 less the 3, 25% of the remaining 12, which would be another 3. And therefore, the investors would get 6 million total, which is 40% of the total, not 20. Even though they only own 25% of the company, they'd still get 40% of the total. Versus non-participating, that would not be the case. They would just get their pro rata share. So these are the sorts of things you need to be aware of when you're going through the term sheet as it relates to the economic considerations. On the command and control provisions, and just as a reminder, shareholders invest the board of directors, and the board appoints the management. So recognizing that is the structure of a CCorp, the preferred may have preferential voting and/or veto rights over activities of the company. So it could vote as converted to common, so everybody votes basically one vote per share regardless of class, or certain activities may require the approval of separate classes. And so when you sell preferred, the investors are typically the majority owner of that separate class. So that may give them a veto right on certain activities. And there's typically a lot of protective provisions that come along, and those protective provisions require their approval if you're going to sell the company, issue stock or debt, change the board, do some other activities. So the bottom line is that when you get a term sheet and start sorting through all these issues, you need the advice of an attorney that is well versed in the terms. And there are some attorneys here in town that specialize in working with startups, and they're usually pretty good with their fees because they recognize the loss leader. They're going to make their money when you raise money or when you sell the company. And another company, and I'm sure Cindy and the team can recommend a few to you if you want to talk to a variety of them. We can certainly provide some names. Other companies will go to attorneys up in Boston or California that also specialize in this with startup companies. But I do recommend you get an attorney who really specializes in working with startups because it will be hard, if not impossible, to undo some of these provisions once you've agreed to them and accepted someone's money. Some of the other CNC considerations I've listed here, vesting of founder shares, you can kind of read them. So anti-dilution refers to the fact that if the company is struggling and needs to raise the next round of financing and the value of the company has gone down because maybe it's missed a milestone or it hasn't performed as expected, the anti-dilution provisions basically say that the investors can make up some of their losses, full ratchet, in which case they'd make them all up, or a weighted average, in which case they get a partial. Right of first refusal, I think, is fairly straightforward. The drag along refers to the fact that if a major decision is made and minority shareholders don't agree to it, the majority can force the minority to agree to whatever that decision is. Let's say a sale of a company or strategic partnership. And then tag along, if a major investor sells its shares, then the minority shareholders have a right to sell some of their shares as well. Redemption provisions refer to the obligation of the company to repurchase shares at some point in the future. Obviously, investors ultimately want to get an exit. They don't want to invest in a lifestyle company. So the redemption provision typically is several years out, but it enables the investor to exit if they need to. So the GRA has a venture fund, a $45 million fund that is designed to support the companies that come through the grant and loan program. It is a separate entity from the GRA, which is a 501c3 nonprofit. The venture fund is a for-profit entity. It has a different source of funds, different decision-making, completely separate company. And we typically invest $250 to $500K with additional capital reserved for future rounds. And at that amount of money, we're unlikely to lead. Depends a little bit on the size of the round that's being raised, but if you're raising several $1 million in a seed round, the lead investor is going to be a big chunk of that, likely to be a big chunk of that. And so given the amount that we invest, we typically don't lead, but we can be a source of introductions to other investors, partners, and potential customers. So we try to help our companies as best we can. So some fundraising advice. If you want advice, ask for the money. If you want money, ask for advice. That's an old adage, but you'd be surprised how often that's true. I've never seen a company execute on its original business plan. It's likely to take longer and cost more. It's kind of like doing a home renovation. Things are going to come up that you didn't anticipate, and it's as I say, I've been in this business over 30 years. I can't tell you how many companies I've worked with, probably close to 200, and I've just never seen one execute on the original plan. Changes are gonna happen. I would say if you can get the money, take it. Don't get fixated on the valuation. especially since the command and control provisions are important too. And try, and I've seen companies that get all excited about a high valuation and then they have to do a down round, and no one is happy in a down round. Those are very difficult financings. So it's better to leave a little money on the table up front and keep the valuation of the company going up. I'd also caution against, and this actually just happened in two of our companies, where investors came in and offered them a really high valuation, which was attractive to management, needless to say. But the CNC provisions were pretty draconian, such that, when the company was going to need to raise the next round, the investors were going to basically be able to dictate and determine to the company what those terms would be. So they might have been getting a great deal this go round, but there was a risk that the next go round might not be so great. These are all things you have to kind of think about, and that's why it's so important to get good advice. I would reminder, just fundraising, it's just one step in a long progression, and you are assuming fiduciary responsibility for other people's money. That's a big deal. Types of investors, they fall into three buckets, your friends, family, and fools. They're typically passive. They're typically one and done. Angel investors that may add some value, because a lot of angels like to invest in businesses that they know a lot about. Other angels may not have experience in that business, so they may add some value, and they may be one and done. One of the challenges with getting investment from individuals is that circumstances change. They may move, they may buy a boat, they may retire, they may get remarried, who knows? Kid goes to college, but circumstances change. So even though they may invest and say to you that they plan to invest in the next round, things may change and they may not be able to. And I mention that because for institutional investors, it's their job to invest. They are going to invest that money. It may not be in you, but they are going to invest that money. And they are actively out looking for deals. So ideally, if you find an institutional investor, you want to find one that has domain expertise in the business of which you're trying to build, so that they can add value, either help you recruit management, introductions to strategic partners, possible customers, can round up other investors who are also knowledgeable about that space. And once they've invested, they're likely to continue to support the company if it executes on the plan. So if asked, I always tell my CEOs, if asked what their valuation expectation is, I tell them, try not to answer the question. You can ask your potential investor what they think is a reasonable round, but I always tell them, respond something like, you're going to be reasonable about the valuation. You're going to be in line with the market. What you're really interested in is the investor's ability to work with the team and, play to their ego a little bit. You want them in the company because you think they can add a lot of value. It's not just money you're interested in. You really want them. Now, that may or may not work, but I can tell you I've heard pitches by CEOs. They make a great pitch, and then you ask them what their valuation expectation is, and it's completely beyond the pale of any kind of reasonable expectation. And it's so far out of bounds that you just don't even know what to do with that. You can't even begin to negotiate. It basically sort of demonstrates they don't know what they're doing. They don't understand the market. That's not the impression you want to leave with your potential investor. So I would try and get them to tell you first what they think is reasonable, if you can. But at the end of the day, you still need to come up with what you think is the value for your business. So, your value is really defined by your customer, and you have to think about what is your business. Most successful businesses are successful because they are faster or cheaper or better in some way than their competition. So you have to understand what is the need of your customer, how important is that need to them, and how much will they pay to solve that problem that they have. And that enables you to articulate the value proposition, the value that you're creating for your customers when they use your product, process, or service, whatever it is that you're offering. And hopefully something that your competitors cannot provide. And then, of course, you need to understand what would cause them to switch. I'll give you an example. We had involved with a company. They had a new product, and it was better by far than anything on the market. It was much more energy efficient, and this was a large piece of manufacturing equipment, so it was an energy hog. The energy costs were high, so the fact that it could reduce the energy costs in a meaningful way, you'd think would be attractive, and actually it also had much lower maintenance costs over its life. So, it was a product that I actually thought was going to do very well, and they were distributing it through the second leading seller of products in that market, who was anxious to become number one, and they thought that this particular product would differentiate them. And so everybody was all excited about launching this product, getting into the market. And what nobody seemed to appreciate or realize, or the cynic in me says maybe it was done intentionally, but the person who was responsible for buying the equipment did not have budget responsibility for the energy costs. So they didn't care about the fact that this particular product would save a significant amount of money in the energy expenses. What they knew was that they had always bought the equipment from this one manufacturer. They were familiar with it, and they continued to buy the equipment from the manufacturer they always bought it from. So they weren't interested in switching to this better technology. That's a sale that would have had to go through the C-suite, and these are big companies. The CEO of that company is not going to get involved in this purchase decision of a piece of manufacturing equipment. So part of me thinks that the company that acquired the rights to distribute this particular product used it to make their product look better, that they weren't really that interested in selling it. They would show it up there as saying, you can have this fancy new product that would save you lots of money, or you can have ours. And so needless to say, that company did not survive and didn't make it, even though they clearly had a better product on the market. So these are the sorts of things you really need to understand. So you can estimate your revenue potential from the product. And when I say product, it's a euphemism, whether it's a process or a service, whatever it is you're offering. You can estimate how fast the market's growing, get estimates on your cost, which then leads to your profit potential, and then try and figure out, how much money are you gonna need to basically get it to the market, and come up with a strategy, and knowing how you're going to approach customers, knowing your value proposition, how much your invention or innovation is worth to your customers, enables you to build a financial model and provide margins that are basically going to justify the financial investment. Any startup must offer investors a credible return, an attractive return for them to invest in the business. And you want to, when you're going through your model, you want to be able to document all the assumptions you used and all your sources to get there, whether it's interviews with customers, or whatever the source is. I might add that the first company I was in, I wish somebody told me this, that if you're going to be raising money from institutional investors, you need to track and document every agreement the company has, because in the legal documents, when you're raising money, you're going to have to list all of them, if not provide some of them to the investor. So it's helpful to have them all in one location. So, from an investor standpoint, what are they going to be looking at? And I can tell you that for me, these are some of the things that I consider when I'm looking at a potential investment, and recognize that, for most institutional investors, the general partner is going to have domain expertise in that specific area. That's what they know. That's what they're investing in. They have a lot of contacts. They're pretty far down the learning curve. For the GRA, because we work with all the universities here in Georgia, and we look at all the innovations and discoveries coming out of those universities, as one of my colleagues likes to say, we see everything from A to Z, aerospace to zebrafish. And so as a result, we tend to know a little about a lot of things, and we rely on others to do our diligence. But in general, this is a list of the things that I tend to focus on. The management team, do they have the knowledge about the business, and do they have the experience to execute the plan? Have they done it before? And is it a full-time commitment for them? With regard to the market, how big is it? What's the competition? I always think that's one of the most interesting questions, actually. What do they think their market share is going to be? I just was talking to a company not too long ago, and I asked the question, and the CEO said 8%, and which sounds great, if you can get 8%. Well, that's usually not a static number. It usually starts lower and grows. And he had his reasons for why he thought it was 8%. They weren't completely supported, but he was at least on the track to supporting it. But you need to justify how you're going to get to the market and how big of a share you're going to secure. And it is a business, so you have to think about how are you going to make your product, how are you going to market, how are you going to sell it, how are you going to distribute it, how are you going to service it. You have to think about it from the beginning to end, particularly from the customer's perspective. They're making a commitment to you, and you need to be able to, support your product. And the business model. What is it? Are you actually selling it? Are you leasing it? Is it the razor blade model? I mean, what exactly is it that you're envisioning? And the technology. Does it provide a sustainable competitive advantage? Is there IP? Who owns it? The financial question, what total resources are going to be needed? I can tell you for the GRA Venture Fund, we're a relatively small fund. So if you're going to need $100 million to get to the market because you're working on some new battery technology or you're working on some new pharmaceutical, we're not going to be able to get you there. So then we're going to rely on the syndicate partners and look at their resources. Will they be able to get you there? Of course, regulatory risk is a big one. What's the path, timing? What's the cost to approval? And, ultimately, what are your expectations at an exit? When do you think that would occur? At what kind of valuation? What are the multiples you're going to be using? Are there comparables out there you can point to that would attract an investor to your particular deal? Investors look at a lot of deals, and they may not do yours, not because there's anything wrong with yours, but they can't do them all, and they have limited time, and so they have to pick and choose. So I know fundraising can be extremely frustrating, so I added these little quotes at the end. It requires a lot of perseverance. You got to stick to it, and so I thought these were appropriate. Let me check and see how we're doing time-wise. 11:39. So at this point, I'm going to switch over and give a little primer on stock options because this is an important aspect of any startup. It's a form of compensation that's used to attract, retain, and incent employees. So there'll be a stock option plan. It's approved by the board. And for the option holder, it only creates value if the company value increases. So what is a stock option? It's basically the right to buy shares at a future date at a price determined when the option is granted. And the grant will include the date that it's granted, the number of shares that you're entitled to buy, and then the strike, sometimes called exercise price, which is the fair market value at the time the grant is issued. But most options have an expiration date of out to 10 years. So that price gets locked in, which means anytime in the next 10 years, you have the opportunity to buy shares at that price. So if the value of the company goes up, you can still buy stock on the cheap. Most option plans do have a vesting schedule, typically 4 years. What I see most often is a 1-year cliff, meaning there's no vesting for a year, and then you get 25% on the 1-year anniversary, and then monthly thereafter up to 4 years. And so what you're really trying to do when granting options, as I say, it's really to recruit, when you're hiring new management, you want them to think like owners. Uh, the vesting schedule will hopefully incent them to retain or to stay at the company, a way to retain their services. And then the incentive is, if the company hits certain, it could be based on the company or their own personal performance, but if they hit certain milestones, they can get additional option grants. So there can be more than one grant. Just as a very quick example, I think this is intuitive, but if you issued options to someone today at 10 cents and 3 years from now, the price of the stock was $1.50, then they would have $1.40 per share in the money. There are two types of stock options. Incentive stock options can be issued to employees only and only by a C-Corp. I mentioned the 10-year exercise period before. There's no tax upon the exercise of the options, but there will be one upon the sale of the shares. So if you've been working at a company for 5 years, your options are vested, you go ahead and exercise and buy the shares, that does not generate a taxable event. But if then 3 years later you sell those shares, then you'll be paying capital gains on the difference between the exercise price and the sale price. So you can see here, capital gains tax rate held. If you hold it for 1 year after exercise and 2 years after the grant, you'll pay capital gains on that difference as opposed to ordinary income. Non-qualified stock options, NSOs, are basically can be provided to anyone who's not an employee, so director, consultant, advisor. And if it's an employee who, for whatever reason, cannot get the benefit of an incentive stock option, the tax benefit, then they're taxed as a non-qualified stock option. So in this case, when you exercise, you get taxed on the difference between the current fair market value and your strike price. So you're paying taxes at the time of exercise. And that's an ordinary income tax rate. And then if you hold it for more than a year, you would pay capital gains tax on the difference between the sale price and the fair market value when you exercised. So there's a big difference in the tax treatment between the two. Obviously, ISOs are tax advantaged, and that's what most employees would want. But non-qualifieds are also useful because, again, you have to be an employee to receive an ISO, and there may be others that you want to incent to help the company, such as advisors, directors, consultants. So that's also a useful tool for those folks. Restricted stock units are an alternative to options. I haven't seen a lot of this amongst our portfolio companies. Most early stage companies go with stock options. More mature companies tend to use restricted stock units. I wanted to mention the RSUs because I think they are becoming more popular, and we did have one of our portfolio companies use them recently. But they basically provide the holder with a commitment to receive value in the future. It could be value in stock or in cash equivalent, but it's basically saying you're going to get the value of a certain number of shares in the future, but you're not actually buying those shares, so it doesn't require any upfront payment. They are taxed at ordinary rates upon vesting, but once they vest, they don't expire. It's in effect like owning the stock, but you're just getting the value of the stock without owning it. So that covers a lot of ground. How am I doing time-wise? I think pretty well.
Yeah, that's great.
So I have time for questions.
Yeah, thank you so much, Connor. That was a really great overview. I think there's a lot of new concepts and vocabulary in there for our scientists and engineers. So I just want to encourage people to ask questions because there are no stupid questions here. These are really going to be some really new concepts, I think, for a lot of the people in the audience. And also, Connor, you did mention if anybody has questions after this that they could email you with questions.
Yes, by all means. And I apologize. I have a conflict at 12, so I can't stay on longer than that. But my email is on the screen there. So if questions come up after today or we don't have an opportunity to answer them today, feel free to reach out.
And yeah, so folks, just do enter your questions into the chat. We do have one question here about grants. It was mentioned that grants cannot be used, I guess they're GRA grants, cannot be used for patents, tuition, and a handful of other things. What are some things that a GRA grant can be spent on?
Sure. So, so supplies, it can be used to support non-equity holders. So if you have grad students, it can be used to support then their, and by the way, I might add, GRA grants we don't pay overhead to the university because we're part of the university system, I suppose. But that's been pre-negotiated. So there's no overhead to the university. So 100% of the grant goes to the benefit of the PI. And it can be, even though it can't be used to prosecute patents, it can be used to do patent searches, freedom of operation analysis, that kind of thing. So there's a wide variety of things that it can be used for. It can be used to pay for, consultants also outside firms that are working. But I think the way I would differentiate it, and let me go back to back to that particular page. Yeah, the way I differentiate it is if it's specific to the company, then it's probably not going to be allowed. But if it can be considered as an expenditure to help develop the IP and the patent application that will be subsequently filed, then that would be allowed. So hopefully that answers the question.
Okay, let's see, we have some other questions here. Some questions from Kyle. What are some considerations that determine the number of board of directors on your board?
That is a good question. Not so much the number, it's really the members, because you're going to be working closely with them. And, if you think about your investors and your board members, all the really big important decisions, ideally will be through consensus, but that doesn't always happen. I've been involved in boards that are split, or there's one or two members that are really problematic for a variety of reasons. So you want to be careful about who's going to be on your board. And I would say for an early stage company, you don't want a board that's too large, because you have to recognize that if you are going to be raising multiple rounds of capital, that particularly if you're raising it from institutional investors, they likely will want to put someone on the board. So you want to leave room, in effect, for the board to grow over time as additional investors come into the company. And ideally, you want a mix of people on the board too. The investors want representation, but you also want folks from industry that can, again, help the company strategically. So there's typically a mix of management, investor rep, and independent person who's knowledgeable about the industry in which you're operating. So short answer is, I've seen 3-member boards for early stage. You generally want to have an odd number, but I've seen 3-member boards that then kind of grow to, I think the largest I've seen generally is 7. There might have been a 9 in there somewhere, but generally speaking, 7 is probably the largest board I've seen. But it usually grows 3 to 5 to 7 over time.
Another question that Kyle had was, when does an investor get a vote on a board? Are the numbers of votes per board members related to the percent equity held by a given investor at a given time?
Yeah, so again, that's determined in the terms, right? So what frequently will happen is that the board is designated in a voting agreement, and it'll say something like, the CEO shall fill one board seat, the common shareholders will fill another board seat, and the preferred shareholders will fill the third board seat. There may be two classes of preferred, so maybe they get two board seats and there'll be an independent. But it's typically not a democracy. So it's not like one share gets one vote. It's usually based on the class of share and what they've negotiated in terms of their rights to appoint a board member.
Another great question that Kyle had was, what kind of decisions are under the purview of the board of directors versus something that the company management decides on behalf of the company?
Sure. So management typically provides a plan for the year ahead, and will submit a budget for the resources to execute on that plan. Each board meeting, the progress against that plan is going to be reviewed, maybe changed. And so if management's given resources to execute on the plan, and so let's say the plan is, we're going to add 20 people, and we're going to hire them in these positions, and we're going to develop a new product, and this is how much money we're going to spend on this new product. It's going to have these features. So if decisions are being made that conform with the plan, then you typically don't need to go back to the board and get it reapproved. Also, the preferred shareholders will have, the protective provisions that they'll include they tend to be more strategic, so related to things like sale of the company or signing a strategic partner, raising more capital, whether it's debt or equity. So they don't necessarily get involved in the day-to-day running of the organization. They really rely on the CEO and senior management team to do that.
Here's another question from Wilson. At the start of the process, I guess he means the startup or company formation process, what contracts or legal mechanisms are typically used to protect intellectual property among the founders and the collaborators?
So I would say that's also a very good question. Just thinking about it, generally speaking, if the IP is owned by a university, right, you're going to have a license agreement from the university to the company. My experience is that generally, once the company is formed, the team is going to continue to develop the technology. So there'll be additional patent protection and other intellectual property that's developed that would then be owned by the company. If you're an employee of the company, you are assigning, it's no different than being an employee of the university, right? You're assigning your rights to that invention to the university. Well, if you work for a company, you're assigning those rights to the company. So they're going to have the first opportunity to pursue it. If they don't pursue it, then I suppose it could come to you. So in thinking about the question, I'm assuming that if you have your own patents and then you're creating a company, then the company would be licensing those patents from you. So I don't know if that answers the question, but that's generally how it would work.
Wilson, if you want to just unmute yourself and maybe, if you have any further, questions here, please do. In case we haven't really interpreted your question right.
It was a good answer. Thank you.
Okay, good. All right. Here's another question.
Investors, I think I'd summarize it by saying investors in the company want to know that the company has the rights to that technology, or they've secured the rights to the technology. So that's the way they're going to think about it. Sorry, Cindy, back to you. Sorry to interrupt.
Yeah, thank you. Is there a central location to where we can speak or find investors, especially at the early stage?
A central location. No, it kind of depends on what type of investor you're going after. Obviously, friends and family would depend on your own network. Angel investors, you can do searches online, and venture investors also searches online. You can ask for introductions. Typically, your attorney can make introductions. If you're a GRA company, we work with a lot of different VCs. We can make introductions. Accounting firms can make introductions. So there's a lot of service providers that might be able to make introductions for you. But uh, going to conferences, getting your name out there. Um, it's the short answer is no. There's no single best way to do it. I would say though that to the extent you can get an introduction, definitely try and take advantage of that because we get a lot of opportunities in over the transom, and there's only so many we can sort through and focus on at any one point in time. Though not surprisingly, people will tend to focus on deals if they come from people they know and respect and trust, as opposed to something over the transom that they've never heard of before.
Are there any more questions for Connor? If not, I guess I have a question for you. So, Connor, so you've been on both sides of this, of fundraising, and also you've provided funding as a venture capitalist. What do you find? So a lot of our folks, are mostly, life science researchers here. What do you find to be particularly challenging about financing life science companies? And do you have any kind of tales from the trenches or interesting stories you can share from your very storied career?
That's a very good
Or
question.
that you can share, because I'm sure a lot of it is.
So I'd say, so each company is, in my own mind, each company, they're the same in terms of, the diligence you do. You try and anticipate all the questions, all the problems that might arise, all the resources you're going to need, how to make them successful. And so to a certain extent, you go through the same process over and over again. But having said that, it's kind of like having kids. Each one is unique in many respects, and so they're all a little bit different. Um, and it is frustrating when you think, like the company I cited earlier, they built a better mousetrap and didn't succeed. Um, and you kind of think back, what could be done differently that would have helped them to succeed. And things like, you're not going to be right all of the time, that's for sure, from an investor standpoint. But hopefully you're right more often than you're wrong. I think the biggest frustration is that you can't do every deal. There's a lot of deals that I generally am interested in that I'd like to invest in, but you just don't have the bandwidth to do them all. And so that kind of gets frustrating from this side of the table. Um, and from the entrepreneur perspective, the position you want to get to, right, is you want to get an offer. Even if it's not a good offer, you want to get an offer, because once a VC has made an offer, they've obviously done a lot of diligence, they've done a lot of work, they're interested in what you're doing, they've made a certain level of commitment, and then it's just negotiating what the final terms are. So if you can just get to that point, then um, then that's what I would recommend. And also thinking about the process, the your objective is to get a meeting. So the intro or any informal information that you're providing, whether it's at a conference or however you're doing it, your objective is to get a meeting. And once you've gotten a meeting, your objective is to get them into diligence. And once you get them into diligence, your objective is to get a term sheet. So there's a sequencing, from the entrepreneur standpoint that you're trying to get accomplished. And don't be afraid to ask VCs about next steps or what kind of diligence they think they need to do for your particular deal and how you can help them address any concerns they may have.
Well, great. Well, we are at 12 o'clock. I'd just like to thank you again, Connor, for a really informative seminar. And thank you so much for volunteering your time for Georgia Tech. We really appreciate it.
You bet. Happy to do it. Enjoyed it. Have a good day, everyone. Happy
Yep.
Thanksgiving this week.
Yeah. Happy Thanksgiving, everyone.